There are three main types of orders in trading. The first is the market order, the second is the limit order, and then finally we have the stop order. Now I'm just going to quickly define each of the three, but then we'll go into greater detail on what each one is on the next slides. So the market order executes immediately at the best available price. This is going to guarantee that we execute, but it will not guarantee that we get a good price. The limit order will set a specific price to buy or sell, ensuring price control but not execution. So we would ensure that we get a good price if it executes with a limit order, but we're not guaranteeing that it will ever execute. And then finally, the stop order triggers a market order when a specific price is reached. This will usually happen in the case of adverse price movements, but let's take a look at each of these three in more depth. So the market order is an instruction to buy or sell a security immediately at the best available price. The key features are that it guarantees execution, but not the price that it's executed at, and it's useful for quick entry or exit from a position. So if we look at an example of an order book over here, we can see what would happen if we placed a market order to sell for this asset. It will immediately execute at the bid price that is the best. So we would immediately sell the thing for $3. Whereas if we placed a market order to buy this asset, it will immediately execute at the best asks price. So we would immediately buy it for $3.05. Now a limit order is going to operate a little differently. We want to get a better price than what's available typically. So a limit order is an instruction to buy or sell a security at a specific price or better. So the key features for this are that the execution is not guaranteed, but the price is. So it's useful for setting price boundaries and controlling cost. An example would be, let's say we want to place a sell limit order at 302 that will execute only if the price rises to 302 or higher. So if we look at all the bids in the queue right now, I cannot sell anything for 302. The best I could sell it for is $3. So I'm basically going to add a limit order where I'm saying, hey, I'm willing to sell this at 302, but I'm not willing to sell it for the market price of $3 right now. So I would get a better price for my sale if the price rises to this point, and I'll be waiting if that happens. Or on the flip side, we could do the buy limit order where, let's say at 303, we're willing to buy something, but we're not willing to buy that for 305. So we need the price to fall to 303 or lower. So the best we could buy something for right now with this order book is 305. We're saying we're not willing to do that. We're going to place our limit order right here at 303. And we're hoping that the market falls and then we can get it at a better price, and we're just sitting there waiting for that. And then finally, a stop order is an instruction to execute a trade once the price reaches a specified trigger price. This will usually happen when things are moving adversely towards the order or the position. So the key features are that this becomes a market order after the trigger price is reached, and it's used to limit losses or secure profits. So let's do an example here. So right now, we're able to sell an asset for $3 if we wanted to. We could sell it for that $3, but we might place a limit order to sell it at $297 so that if the price drops to $297 or below, it will execute. So why would we do that? Well, we might be comfortable with holding this asset, but we're thinking, hey, if it falls all the way to $297, I kind of want to get out. So we might place our limit order down here at $297, and then if the price falls to that, this will trigger and sell at that price. So it's sort of a protection thing against the price movement really moving against your position. Now we could do that on the flip side, on the ask side or the buy side. So we could place a stop order to buy at 310, which will execute if the price rises to 310 or higher. So right now we could buy this for 305, but let's say we only really want to buy this asset if the momentum is really swinging in the right direction. So we might say, I don't really want to buy this right now at 305, but if it rises to 310, I want to buy it then because there's good momentum with this asset. And now we can see in our brokerage account, let's say we wanted to trade an option on the largest S&P 500 index, SPY. We can go over here to the option chain. And then once we're at the option chain, we can click on any of these options. Let's say we're going for the one that's 582, a 582 call. Now we can go up here and click, let's say we want to place a buy order on this. We could do the market order, which would just try to execute immediately, and we'd likely buy it for that 108 ask that's sitting there. Or we could go and try to place a limit order where, let's say, we don't want to buy at 108, but let's say if the price falls to, how about 105, then we would be willing to buy it at that point. Or we could go and place a stop buy order, which says, hey, we don't really want to buy this at 108, but if the momentum really swings in the right direction and this goes up to, let's say, 110, then we would be interested in buying it. And we could set however many quantity you want and then submit our order that way. This video is a part of my course, Options Theory to Practice. I'll guide you step by step through the fundamentals of options, all within a safe and controlled paper trading environment where no real money is at risk. You can learn more via the link in the video description or pinned comment.